Which leads us to the thing that Steve and I think needs a lot more consideration as a solution, and that is debt restructuring. Writing the loans off and rewriting the contract with the consumer. As soon as you mention that, by the way, you get a lot of objectives about moral hazard and a lot of objections regarding wealth transfer. But in our view, $1 trillion in debt restructuring on the private side is as good as $1 trillion in stimulus from the federal government, and probably better.
Just want you all to remember that this is a former credit card CEO suggesting this.
Well, 70% of...
Unusual moment.
70% of... I'm out of the industry. Consumer debt, mortgage debt is 70% of all consumer debt. So we have a little modest solution to propose. We propose that financial institutions write down the underwater portion of mortgages over a 20-year period. We think that number's probably somewhere in the $500 billion to $1 trillion range. It may be less, it may be more. The financial institutions that do this should be given over that same 20-year period offsetting tax incentives that cover their costs and provide them a little bit of incentive to do that. We think that should be done in the regulatory accounting context. We think that Fannie Mae, Freddie Mac, other private institution and banks should all be eligible for this. We think that since some institutions don't care about regulatory accounting, it's a non-issue for them, that regulated institutions such as banks should be able to purchase mortgages from them, effect this write-down, get the incentive, repackage and resell. The net of it all is the consumer has a lowered mortgage. When consumers have less debt, they have more capacity to spend. That's what makes an economy grow.